Consumer credit numbers have come out. What's going to happen in the media is you're going to watch these articles, you're going to watch these news channels, they're going to say, oh my gosh, consumer credit is up X billion dollars. And you sit there and say, oh my God, that's insane, that's crazy. I don't blame you. Remember, it's easier to sell on fear than it is to sell any other way. However, the way I hear it, when I hear that is, oh great, it's up X billion dollars. How much is GDP up? I want to see what consumer credit is looking like relative to GDP. As an example, let's just do this real quick because I want you to understand that in and of itself, any number by itself doesn't mean much to me. So let's say, for example, consumer total credit card debt in this country is $100 billion, which is way more than that, but whatever. But let's say GDP at the time is 20 trillion, just to make it easy. Okay, so basically it's a 0.5%. All right, makes sense, 0.5%. Now, all of a sudden I told you, oh my gosh, guys, consumer credit went up 20% to $120 billion. You might be like, oh my God, that's crazy. But if I followed up with, yes, but GDP grew to 40 trillion, that actually sounds pretty good. What are we at now? 0.3%. Is that correct? Yeah. So I look at this saying, all right, I understand why we get concerned about consumer credit. Now, you might sit there and say, okay, how much is it up? 20% relative to GDP? Okay. Now, I look at this number, and this is the article that was sent to me today. In January, credit card balances rose 11.1% on an annualized basis. Now, that does bother me. Why? Well, let's go look at GDP. A very quick search for St. Louis Fed GDP. You're going to click right on it right here. And we're going to look over the last 5 years. So we're at 26.144 in Q4 2022 versus 24.349. So 26.144 divided by 24.349. This will tell me the GDP growth in that same time period, year over year. So 26.144 divided by 24.349. Okay, GDP is up 7.4%. Now I'm more concerned. I sit there and say, all right, that is a concern of mine. Credit card balances are up 11.1% and GDP is up 7.4%. And GDP over the long haul is what the entire country is going to make, right? Now, why is that? Well, we've had a big jump in inflation. Inflation has skyrocketed. People's incomes take a long time to recover to match that inflation growth. So what do? They swipe away. Because you've always heard how many people out there are living paycheck to paycheck. There are even reports about something like some absurd percentage, like 40% of people making six figures are living paycheck to paycheck. I don't remember the exact number, but it's an absurd number. So guys, if you like what you're hearing so far, or you know somebody might benefit from this, I need you to do two things. One, subscribe to the channel, and two, forward this on to somebody, because on this channel, we talk a lot about personal finance, investing, all these aspects that make a lot of sense in terms of understanding the world. And I'm not going to sit there and say, this is the future and this is what's going to happen. However, I will sit there and say, okay, based on where we are today, what does that say about the future? Well, when I look at credit card balances, whenever you're taking on debt, you're taking away from your future, right? Think about it. When you take on debt, you're committing yourself to future payments. So you're committing yourself to payments in the future that don't allow you to live a certain lifestyle in that future. The same thing happens with the country. When we take on all this debt as a country, this is what's happening. Now, some of the other things I want to show you that are kind of interesting. I wanted to pull up household debt to GDP by country. And this is actually interesting to me. The number one country, Switzerland. I actually would have thought Switzerland would be a lot lower. Their household debt relative to GDP is 130%. Australia, and by the way, Australia went something like 30 some years without a recession or something crazy like that. We're not even in here until boom, right down here. What number is that? 2, 4, 6, 8, 10, 12. We're number 13, 75.6%. Again, what does this mean? I don't know. However, I would have thought we'd been way higher than we are right here. Like to look at Thailand being 89%. I don't understand the numbers behind this. I don't know what kind of debt they're talking about, but this actually surprised me in a good way. I was like, oh, we're not as bad as other countries. That doesn't mean that other countries are, that just because we're at number 13 means everything's hunky-dory. Not at all. But what it means is I definitely would have thought our consumer society of 70% of GDP being consumer would have been, I would have guessed, actually we were number one on the list, if you'd asked me to guess. All right, now, another example here. Total consumer credit owned as a percentage of GDP. All right, instead of getting, I want you to look at the long-term trend. This goes back to 1947 or something like that. We were at around, what is this number? 1947, we were at 4.14% of GDP, and we're currently at 18% of GDP. But if you look at the way we live our life, since 1947, everyone in this country is a lot wealthier, has a better quality of life. There's more stuff, they have more computers, more cars, more everything. The biggest jump was right here at COVID, which makes sense, right, guys? COVID, the entire country shut down, incomes had stopped for a long time, so people put a lot of money on credit cards and had to take on more loans. And then since then, it's dropped. But why has it dropped so much? Well, GDP has skyrocketed. If you want to look at GDP, since COVID, let's take a look at that. So here's GDP since COVID. It fell to 19.6 trillion and is now at 26.1 trillion. That is an increase of what percentage? So that's $6.5 trillion on 19.6. That's almost a 30% increase. That's going to really drive down your percentages if consumer credit isn't up that much. Now, I don't want to have too much consumer credit. There is a healthy balance. What's that healthy balance? I have no idea. The unfortunate part about this chart is it's just showing upward movement. It's not like the other charts where it goes like this and we can see an average along the way. When you have everything going up, is this good or bad? I don't know. I don't know. Now, more people probably own homes here than here, and I'm pretty sure that credit is involved, household debt is involved in there somehow, some way. That's not here. But when people take on more houses, guess what happens? They borrow more money to furnish those houses. You do a lot of other things that you must do as a homeowner, okay? More cars. What was the average number of cars here versus here? When you have cars, you take on more debt. This is all part of this consumer lifestyle that we live. And that is why 70% of our GDP is consumer spending. We're a consumer society. There's a lot of other countries in the world that are not consumer societies yet because they haven't advanced their economies like we have. Is it good or bad? Well, what's the right number for consumer credit? Debt as a percentage of GDP. I don't know the exact number. We are in an uptrend. We absolutely are. People have more stuff than they did 70 years ago. That is an absolute fact. Go look at the way your grandparents live versus the way you live. Go look at the way your parents live versus the way you live. You probably live a lot more superficial than they did back then. That's okay. It's not meant to be a criticism. That's why I hate using that term superficial. Look at what I'm wearing. My parents do not have the clothes I have. They don't spend the money the way I spend the money. But they're also off the boat immigrants from the Middle East who had nothing growing up. So their desire to have stuff is a lot less than mine. However, that's the way it is in the U.S. That's just the way it is in the U.S. Now, there's two ways this number can fall big time, right? Well, GDP can skyrocket like it did here. Or another way is consumer credit can go down. And right now we have 3.4% unemployment. I don't know what happens if all of a sudden we go to 6% unemployment, like we're discussing now with Powell and all these other things. And in order to keep inflation down, we got to raise rates, which will probably cause people to lose jobs. But at some point, there's got to be some sort of evening out. Just like when we saw this big surge here, there was an evening out that GDP went up. People started to pay down their debts. It was probably a combination of both of those things. This is the world we live in. There's a bunch of things moving together. There's a lot of different moving parts of the economy, and you have to figure out what makes the most sense. I think we can all agree, though, that debt in and of itself, if it's just to buy stuff to live, is probably not a good thing. In the long run, it's not a good thing. Now, if you need to put on a credit card, clothing to go good to a job interview to get yourself a job, do it. But if you're putting on a credit card in order to be able to pay your groceries, there's probably some disconnect there in what you're making versus what you're spending. And that's what I'd encourage you to go sit there and put a budget together. And we actually have a free budget below. Go click the link below. If you want to get started, we have a free Excel budget. It'll get sent to you. It's awesome. It's great, blah, blah, blah. Debt is a part of life. If you want to own a home, it's going to be very difficult for you to pay cash for that home. That's okay, because you're buying an asset. Contrary to what a bunch of other internet idiots will say, you are buying an asset when you buy a home. And the bank doesn't own your home. The bank merely lends you money to buy your home. And over long periods of time, as GDP continues to go up, your home value will probably go up in some similar fashion. Because GDP is income, and as incomes go up and as inflation increases, the value of your home will do that as well, no matter where you live. Now, there might be some areas where it grows faster than others, but overall, you're still going to see increase in the value of your home. But again, if you're using a credit card for everyday purchases on a consistent basis, you've got to reassess and say, hey, what are my priorities here? I'm taking away from my future by spending today. And then you're paying some ungodly interest rate to the credit card companies in order to pay that. Upwards of 25%. Do you know how long it takes to pay off a 25% interest loan? It's an insane amount of time. We're complaining nowadays because home mortgages are 7%. Some people are paying 25% to just literally live day to day. And I truly, truly believe that's a personal way of living. It's not, you can sit there and say, well, it's because of this. I can find ways in which to save. You can find ways in which to save in your everyday lifestyle. And that's what I encourage you to do, especially if you're concerned about the future with rising interest rates and potentially higher unemployment. We can do it. Every single income level, I can find you somebody that's responsible and find you somebody that's irresponsible. I can find you somebody making $5 million a year that's irresponsible with their money and will likely go broke. I can show you somebody with $50,000 a year who lives well within their means who'll be a millionaire someday. Are you really telling me that the $5 million a year person can't live off that? Come on, give me a break. Just like everybody can live off $50,000 a year. Yeah, you might have to make a lot of sacrifices, but you can live off of $50,000 a year. You can live off $30,000 a year. The point is, what are you willing to do that? Is that okay for you? So when you hear these numbers of consumer credit and all these things, take it as a piece of a much bigger picture. What does it mean in relation? Don't fall victim to this, oh my gosh, there's $10 billion, $100 billion. Okay, but what does that mean? If the U.S. economy went from 26 trillion today to 100 trillion, I would fully expect consumer debt levels to go higher. And if they're higher by 50%, that's a win. That's a win because the economy went up 4 times. That's 300%. Guys, if you like this, again, subscribe to the channel and please share this with somebody you know. Thank you very much.